The U.S. Treasury Department, on the 8th business day of every month, report the previous month's deficit numbers or surplus numbers. And that day, the U.S. government reported that for the month of August alone, the fiscal deficit was $380 billion. That was, what? In a month?
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Craig Hemke joins us today. Craig is one of the more colorful analysts out there, and having spent some time as a licensed security professional, Craig knows the ins and outs, especially with precious metals. And he has dedicated this part of his life to share knowledge with us in his TF Metals report and its community. And we're delighted to have Craig join us once again today. It's time to saddle up and silver up for Craig Hemke. Craig, welcome back to SBTV. How are you doing?
Patrick, my old friend, it sure is nice to see you. I'm doing fine, and I hope all is well with you.
All is well, and I'm very happy to see you also. So thank you again for being on. Craig, first question, the movement we are seeing with gold, in your opinion, what's driving it?
Boy, that's the question of the year, isn't it? When the year got underway, going all the way back to January, I thought, by the time we get around to the Fed actually cutting rates, we'll probably have gone sideways for about the first 6 months of the year, and then we'll finally break out. We'll go to about 2,300, and that's maybe about the best we could expect, because as we entered the year, the talk was, the Fed's going to cut 6 or 7 times, and the dollar index was down around 100, and, had you known then that those rate cut expectations were going to get trimmed back to basically zero by June or July, that the yield on the 10-year note was going to go up 50 basis points, that the dollar index was going to go up by 5 or 6%, you'd have thought, oh man, boy, we're in for a tough start to the year. And instead, gold takes off. And I first to admit, I was pleasantly surprised by that. Once it actually broke out of its 3.5-year range back on March the 1st, it was just off to the races. And then eventually the attention turned to silver, and why isn't silver moving to catch up? And then silver moved to catch up. Gold then goes sideways through the summertime, then breaks out again. And so we've been waiting for silver to break out again. Now that has happened as well. So it's been a very exciting year. What ultimately, though, is driving it is really hard to put your finger on. I think central bank gold demand is obviously a big driver, because this is going to be the 3rd year in a row of record central bank demand for physical gold. And you can certainly see this across, whatever you want to call it, the developing nations, the BRICS, the global south, whatever. You can definitely see every month, India, Turkey, just go down the list. They're constantly adding gold. But I think we're starting now to get enough headlines, that people are paying attention to gold in the first, that, wow, look at that gold go. I wonder what's going on. But then you get news like the fiscal situation here in the U.S., Patrick. And I think this was an underappreciated moment about 6 weeks ago. The U.S. Treasury Department is supposed to, at least, on the 8th business day of every month, report the previous month's deficit numbers or surplus numbers, or, how much income they took in through taxes and fees and how much they spent. Okay? 8th day of every month, that's supposed to come out. 8th business day. Well, that turned out to be, for the month of August, that was like September the 9th or 10th or something like that. And that day, the U.S. government reported that for the month of August alone, the fiscal deficit was $380 billion. And hell, for me, it was like, what? In a month? $380 billion? And I think that kind of, if you're a fiduciary managing retail money, hedge fund money, whatever, that was kind of a shaky by the lapels moment. Like, wait a second, this is really getting out of control. And gold has moved up about $150, $200 since then. And I think, so I kind of got this combination of factors that just keeps putting a bid under gold and keeps moving higher without a sustained pullback. The fiscal year in the U.S. runs October 1st to September 30th. So we just finished fiscal year 2024. And the total annual deficit, added all the 12 months together, was $1.83 trillion. Patrick, when I was in college, working on my econ major, it was back during the Reagan years. And back then, the U.S. was running a $240 billion annual deficit. And the fiasco and the calamity. And now, like I said, we ran $380 billion in a month, $1.8 trillion in a year, under what is alleged to be this robust, strong U.S. economy, right? So what happens when the recession, and I think it's actually already beginning, when the recession hits, economic activity slows down, corporate income taxes start to fall, personal income taxes start to fall, and all that revenue to the government starts to contract. While the government tries to, stimulate economic activity by spending, well, we're going to be running $3-4 trillion deficits. And that debt is just going to start kind of growing even exponentially really faster. In that fiscal year we just completed, the total service cost, the amount of money the U.S. spent just simply on interest, $1.13 trillion last year. So what happens when that goes to $2 trillion? Again, you can see where this just starts to spin out of control. And I think that revelation is not just something, some fringe goofball website like mine talks about now. This is something that is conversation among decent people. And again, I think that's all part of what has really lit a fire under gold this year.
Yeah, that's a great point again. But no, it's definitely not a goofball website. But Craig, in I believe about 13 months, it's just over a year, we haven't seen. I don't think we've seen any major pullbacks in gold. And the thing is, you know the COMEX very well. Have you seen any significant open interest numbers in these past 13 months that normally would, let's just say, pull the gold price down a bit as it has done so many, many times before?
And again, I'm just straight total amount of contract open interest. We're not at anywhere near historical extremes. Even in silver, which now, has taken off in the last couple of weeks, total open interest in silver is 150,000 contracts or so. You can go back to May when silver first broke out and was traded up around 32 and 33. We were about 190,000 contracts. So we're still 15, 20% below even that peak. Now positions have gotten more concentrated. The net short position of you want to call them commercials or the swap dealing banks or whatever, those positions gotten pretty high, almost historically high. The net long position of the hedge funds and the speculators, that's getting up there too. But that's the funny part. It's not like there's been some big, huge rush of new hot cash that has come onto those exchanges. And so that's another peculiarity of all this. You mentioned no real pullbacks since about this time last year. It was early October when it all seemed to, in a way, I think it's just coincidence, but you had the Hamas-Israel thing began on October the 7th. And that was about the time that gold started to take off. It was in early October. And it was about $1,850. So we're 50% higher. But it has been like any classic bull market in anything. Nvidia, whatever you want to pick, is just a series of higher highs and higher lows. You get these pullbacks to the 50-day moving average and you get a bounce and then you move higher. And you can see this in the gold shares as well. So it's really on any level, it's pretty healthy setup. The thing that I think concerns me after have been doing this for so long is that concentration of positions. You can look at the, say just the swap dealer position, as we call it, the swap dealers. which are, what are swaps? They're derivatives. Who deals them? The banks. So when you see that category on the commitment of traders report, we're talking mainly about the bank trading desks, the big bank trading desks. And they're net short. Well, we'll see what they are in the next survey, but I don't know, 40,000, 50,000 contracts of silver net short. Well, that's a couple 100 million ounces. So every dollar that silver goes up, that's a paper loss of a couple 100 million bucks. And that adds, pretty soon you're talking about that's real money, right?
Yeah.
So I worry that those positions get so stretched and extreme that you start seeing some shenanigans to try to get the price back down. But for now, like I said, we seem to be doing okay.
If you're enjoying this interview with Craig Hemke and I, please do consider subscribing to our YouTube channel. And if you are already a subscriber to this channel, please do check to see that you are still subscribed to this channel and have not been unsubscribed. I myself have been unsubscribed from this channel without my doing or knowledge. As always, if you have any questions about wealth protection, storing offshore precious metals, or even generational wealth, please feel free to email me, patrick@silverbullion.com.sg, and be sure to visit our website, www.silverbullion.com.sg. Yeah, I agree. Seems to be doing okay. And of course, I'm concerned about these shenanigans as well. But Russia recently came out and they said they're going to be buying up silver and adding it to their reserves. How do you think that's going to play in?
Until we see what the actual numbers are, if it's significant enough, that story is a little bit like the Samsung battery story. Remember that from a month or so ago? And I mean, these are real stories. I'm not trying to downplay them, but this idea that this new battery is going to soak up a couple 100 million ounces a year of mine supply. Okay, yeah, it might, but it's not like next week. And the idea that Russia is going to start adding silver and other metals to their foreign currency reserves, like they've been doing with gold, that's great. But I kind of need to see. And then when you get the reporting, is it accurate? Is it honest? But if they are, I mean, again, anything that soaks up physical supply and forces even more leverage into this fractional reserve pricing scheme we have, stresses that system. And I think that's what we're all waiting for, is the reemergence of some sort of level playing field pricing where price is discovered. You can use a little bit of leverage, okay, but 100-to-1 leverage or whatever it is that's not a fair pricing scheme. So anything that can force a deleveraging of the system, and it's that physical bank run kind of thing that will ultimately do it. Anything that leads us down that path is a good development.
Craig, with the precious metals, particularly gold, people may not recognize this, but for those times we've heard $5,000 an ounce gold, $5,000 an ounce gold. We're more than halfway there now. Craig, where do you see gold going, and will the pace continue?
That, the pace is the question a lot of times. Because I see these things too. 3,000, 4,000 could be there by the end of the year. All this kind of stuff. Under the current pricing scheme, that's not typically how things unravel, right? It's almost always 2 steps forward, 1 step back. That's what we're seeing now, just a series of higher highs and higher lows. What there hasn't been is a big washout pullback that has allowed the banks to kind of flatten their books ahead of the next rally. They've just had to accumulate shorts and just keep shorting and supplying liquidity by taking the short side, against new long demand from hedge funds and the like. And so that's how these, the positions have gotten so large and concentrated. But as long as we're under this pricing structure, you're not going to wake up overnight and see, these $100 and $200 moves, because the banks are going to fight that. At least they always have. I would assume they will as long as they can. So that's one part of that equation. the other part, too, is, people say all the time, well, if the metals have been manipulated by these banks for profit over all these years, how come the price goes up? Well, because you can manage that. Like I said, in this process of higher highs and higher lows, they can manage that effectively. Gold can go up 10% a year on average. And these bullion bank trading desks, they're still profiting. They're still in business. They're still, again, these are bankers we're talking about. If the precious metals trading desk was losing money year over year, they just shut that shit down and, but they're obviously making money at it even when price is rising. I think the problem, I've always said, is the 30% years, the 40% years. That, to me, always seemed like that was more difficult to manage. And that's the kind of year we're having this year. And so does it get away from them? That's ultimately a question. I guess the next thing that's on my mind, Patrick, and I've been using this prop. I have a prop for you.
Sure.
You like that? Can I bring in a prop?
Yeah, of course.
Even under this pricing scheme, okay? Nixon closed the gold window in 1971. Americans were allowed to own physical gold again on January 1st, 1975. The COMEX, coincidentally, began trading gold futures on December 31st, 1974. That's an interesting coincidence, isn't it? But anyway, even under this price discovery scheme, gold has gone from 35, 42, up to 200, up to 800, back to 200, right?
Mm-hmm.
Here's the thing. As I reach forward, you get a good look at my face. So I have this, right? Look at this. Ooh, Craig's got himself a 400-ounce bar. No, actually, it's just a piggy bank, okay? So nobody needs to break into my house and think that I've got, but this is the form that most people have seen, right?
Mm-hmm.
Okay. That's they call that a London good delivery bar. So in London, the standard is these 400-ounce bars that they stack, on a pallet, and you see them. Okay. 400 ounces. It's not pure gold. A lot of them, some of them, anyway, we don't have to get into that. But again, this is the idea. So back when Nixon closed the gold window, to acquire one of these babies would have cost you about $11,100. Okay. By the late 90s, to acquire one of these babies was $110,000. Today, at $2,700 gold, this is $1.1 million. So what has changed? This is the same bar.
Yeah.
The gold hasn't changed. Okay? The purchasing power of the dollar has changed because now it takes 1.1 million of those greenbacks to buy this same thing. So even under this current pricing scheme, this reveals to you the destruction of the purchasing power of the dollar and all fiat currency. I think you could even imply, Patrick, if we can both make it another 25 years, maybe this will be it'll cost you $11 million, right?
Yeah.
Gold would be, rather than 35 to 350 to 2,700, this might cost $25,000, even 25 years from now. And again, this is your protection against that madness. This hasn't changed. This is the same bar. And that's what people need to realize as in why we own it in the first place. But in terms of price, can it go, if that just keeps, even under this current pricing scheme, that would imply that price will just keep going up 8 or 10% a year. And who knows where it'll be 20 years from now. But I think we got a pretty good idea.
Yeah. You're giving me the itch to go out and get some gold. So
Get some.
yeah. Hey, but before that, the comics, we saw the London gold pool where they actually tried to manage the price as well. Would you mind kind of summarizing even what that was before the comics?
Well, that came at a time when the dollar was still convertible into gold, right? You could show up and have $35 and get an ounce of gold. After, this kind of goes back, got to give everybody a little history lesson. But after the destruction of World War II, there were no functional currencies that could be used, in global trade, except the U.S. The U.S. had a functioning economy because, we were separated, from everything by the oceans. And we had all the gold. We had 25,000 tons of gold. And so to restart the global economy, the US dollar was made the global reserve currency, and every dollar was backed by gold. You could exchange it. You could accumulate dollars. You could swap it. And it gave everybody confidence in using it, that it had value. And, you had this great boom in the Marshall Plan and, the great boom in the 50s and all this kind of stuff. Well, the problem is by the late 50s, even 10 years later, in their foreign currency reserves, countries had accumulated dollars. They export whatever to the U.S., they get dollars back. Now they got these dollars. What are we going to do with them? And they started wanting their gold. And by like 1958, the U.S. had already lost a third of its gold reserves through that, people showing up and wanting. And this was a massive scandal. You think of the 1950s, Richie and Ponzi and Fonzie and everybody else having a good time. This was a huge scandal. All right, what are we going to do? How are we going to, and again, it was all in support of that $35 price. Well, by 1961, the U.S. decided, well, we'll work with 7 other of our allies. We'll all pledge physical gold to defend that price in London. And so if, price got up to $37, they'd dump some physical gold onto the market. Price would go down to 33, they'd buy it back with the idea of it always kind of staying within this region of 30. Well, the problem is wars, the Great Society, everything else prompted the U.S. to just keep needing to create dollars. And more and more dollars came in. And all of a sudden, there wasn't enough physical gold left in London to satisfy at that price. And so the gold pool collapsed. So now the U.S. is back on their own. 3 years later, Nixon looks around and goes, man, if we don't suspend this convertibility into gold, we're not going to have any left. And that's the origin of what happened. When you are trying to defend a price with physical, there's just only so much of it around. And this imbalance, it's like rent control, that sort of thing. Anytime you try to falsely defend a price, eventually you just get overwhelmed because of the demand. The laws of economics are always going to apply. And that's what killed the London gold pool. And that eventually is what's going to kill let's call it the London, New York derivative pool. Because you've got to have physical metal. You've got to be able to settle physical trades at your derivative price to give your derivative price any significance. You could sit there and say, yeah, look, on the COMEX, gold is $1,500. But if there's people lining up to buy it at $1,500 and you don't have any at $1,500, the price ain't $1,500. So the two have to kind of reflect each other. You've got to deliver metal at that price, however you derive it. Boy, this is getting really bad. For everybody watching, I apologize. It's fall where Craig lives, and there used to be leaves on that tree. Anyway, all of these schemes eventually collapse. And are we seeing the first stages of that in London now? Yeah, there are a lot of hints that that's all part of the problem with all of this ongoing demand. And people waking up, not just central banks, individuals. Like you just said, Patrick, you're like, yeah, what? Now that you mention it, I need to get some more. And as that catches fire globally, that becomes an issue for the banks.
Yeah, completely agree with that one. Thanks for that bit of a history lesson because
Professor Hemke.
It's a good one because I think today when moving forward a bit and we hear the BRICS talking about their unit and this 40% gold backing and they've been talking about it for a while, but we haven't seen it yet. It hasn't come out yet. So I just wanted to know your opinion also on this 40% gold backing of the unit.
Well, again, like we were just talking about, why did the dollar become the reserve currency in the first place? Because it was backed by gold. And when it was backed by gold, it had, you had confidence in it, right? This is because of the stability that gold would add. And so in that same vein, that's why any new currency would probably have some level of a gold backing, right? So that these countries that might use it for, trade between their, the two countries, India and China, for example. If they're going to use something like that outside the dollar, well, they may not want to use their own currency. If you're in India, you're like, I don't know if I want any of these renminbi. I think we'll stick with the dollars. But so to take that currency risk out, you use the central currency, the reserve currency, the dollar, because it's perceived to be safe or stable. If you want to use something else in that matter, well, then you're going to back it with gold. And this unit you're talking about, some of the things we've seen so far that they're thinking about is 40% gold and then 60% a basket of other BRIC country currencies like the special drawing right of the IMF. Again, that gives you confidence in the stability of that trading currency, and then that gives you a reason to use it. It's a process that's been going on really since the great financial crisis. It was a slap across the face of all these creditor nations, like, oh my God, they can just devalue the dollar anytime they want. It then got sped up with the war in Ukraine when, again, creditor nations looked around and said, geez, if we get sideways with the U.S., they'll just cut us off. I don't want to get sideways with the U.S., but eventually a time might come where our national interests diverge from theirs. And then they just cut us out of the SWIFT system and freeze our foreign currency reserves. We better come up with a different system. And so it's heading in that direction, but it's a process. In the end, what investors need to know is it's not a binary thing. It's not like one day there's dollars and the next day there's something else. It just doesn't work that way. It gets back to simple supply and demand again. Okay, any competition to the dollar does is it reduces demand for dollars. Okay, so you're shifting the demand curve. At the same time that the supply of dollars, as we discussed earlier, a couple $1 trillion in new debt every year, the supply of dollars is increasing. So you're shifting the supply curve. This is, just like economics. Anybody took in a university or high school or whatever. If you have an increasing supply and decreasing demand, the price of that good falls. Is anything. Oranges. If you've got a bumper crop of oranges and suddenly they figure out that orange juice is carcinogenic, the price of oranges is going to fall. Okay? And that's the same thing. So what happens is it accelerates the devaluation, the value of your dollar. Here comes the thing again, which then increases the value of that thing because it's priced when it's priced in dollars.
I just want to ask you about the elections, U.S. elections coming up, because by the time this comes out, we're going to be right on the doorstep of it.
Yeah.
Regardless who wins, when the election is over, will the U.S. find a bit of peace and unification? Because by extension, that also translate to a little bit of peace and unity within the world as well.
Yeah. Yeah. I'm afraid. And I don't mean to be all doomsday, but I'm afraid no. You look at it and you think, if Harris is declared the winner, there's a whole group of people that think, well, that's only because they cheated. Because look at how terrible of a candidate she is. If Trump wins, there's a whole group of people that think, oh my God, this is the end of the world. Yeah, I mean, remember in 2020, all the like Antifa riots and all that kind of stuff that we had? So I just have a hard time seeing where there's any reconciliation between the groups. I mean, the polarization just gets worse and worse. Now, from a policy standpoint, that may limit one way or the other, what either party can do. And oftentimes gridlock is, okay with corporations and individuals, because we're not increasing taxes. We're not, all that kind of stuff. But I don't see where societally any of this is positive. Maybe by the next election cycle, there'll be some unifying figure or something that everybody can get behind. But I fear for what the environment's going to be. And the other thing too, Patrick, we're not going to know. And most developed, where are you? Singapore?
Yes.
Right?
Yes.
Do you guys know whenever there's any kind of election, like the next day, later that day, who won?
Yeah, we know it pretty quick.
Yeah, like within hours,
Yes.
right? And here in the U.S., they're like, oh yeah, we're not gonna know for a good couple of weeks what happened here in Michigan. Like, why? Like, what is going? And so the longer it drags out, whether those are legitimate reasons or not, that's just going to lead to more and more angst and frustration, and everything else that goes with it. So I'm not optimistic about how this is all going to play out over the next couple of weeks. And, whether that means trouble for the stock market,
Yeah.
I don't know.
That was where this was actually leading to, because should things, really be unpleasant, what happens with the trust and security of the stability of the dollar, and what would happen
Yeah.
with gold and silver, perhaps? So yeah.
Yeah. You wonder, right? But the other problem, though, is, Patrick, is the degree to which, again, we don't know. We can suspect the degree to which things are managed for perception's sake. People do call me crazy, but I think I could make a case where the Federal Reserve and the Department of Treasury would be interested in keeping oil prices low. Okay, right? Key
Okay.
driver of inflation, and we're fighting inflation, right? And we got to get interest rates down because of that debt service cost and everything else. We can't get interest rates down if inflation is roaring. So that's one reason. Second, Biden administration sold off all that oil out of the Strategic Petroleum Reserve, trying to depress prices. Now they got to buy it back, so there's a reason to keep it down. So you can come up with all kinds of rational reasons as to why they'd be interested in keeping price down. And then you look at the price action on the NYMEX exchange every day, and a lot of days, regardless of the news, gold just goes straight down beginning at 9 o'clock Eastern when the NYMEX opens. You're like, huh. I wonder if, somewhere someone has deep pockets on a trading desk that is managing all this concern out of the Middle East, and crude oil price never seems to go up. So and again, I don't know, call me crazy. I'm just a guy that watches this shit day after 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 day for 15 years. Maybe I'm getting a little loony. But if it's possible that some markets are managed for perception purposes, why can't the dollar be managed? There are a lot of people that think the stock market is managed through things like the VIX index, because if you can get the VIX to go down, then the chain reaction starts of the algos that see the VIX falling, and then they go buy S&P futures, and you get this kind of virtuous cycle. So if you can just simply manage the VIX, you can get the stock market to go up. So anyway, that's a long answer, probably not what you were expecting for me to say. But so it's possible, even in times of strife and craziness, that the perception put forth by the markets could be that everything's great.
Yeah. No worries. I wasn't expecting anything except what you felt was going on. And besides, you're a golfer, so I know you're an honest guy, and you're going to
Right.
yeah. I know you're
No
gonna
foot wedges.
I know you're gonna give us a very truthful opinion. But Craig Hemke, before we wrap up, can you tell us how we can follow you and support your work?
Well, I've alluded to this a few times. You can maybe see it behind my head. The tfmetalsreport.com is next month going to be 14 years old. They say, have you ever seen that, Patrick, where they say you're supposed to change careers every 7 years just to kind of keep yourself?
I'm
Well, I'm
not.
just
I
blessed.
can't agree, because I think I hit 7 years with Silver Bullion, and I don't want my boss to think I'm gonna have that itch to go anywhere else. So I have to disagree, Craig.
All right. Well, I missed the first 7 year thing, and now I've done 7 more. So maybe I am starting to kind of lose my marbles a little bit. Maybe it'll be 14 years. But the thing about the site, and people would beg me to never shut it down, because it's a very valuable resource for the people that use it. And not like what I do. I look at charts, and I talk about everything that's going on in the world every day. Try to keep people like as almost like a news source in a way. I also do podcasts every day to talk about what the prices are doing, where I think prices are going from here. My accumulated experience has taught me. But the site, the people that use the site, like I'll give you an example. So as we record this, yesterday, Thursday, all of a sudden my trusty 8-year-old MacBook just seizes up and dies. Just a hard drive crashes. I'm like, oh. I can't record a podcast, so I have to just type a podcast up on my iPad, and I tell everybody what happened. There must be 25 comments on that thread about not gold, but about external sources of how you can back up your hard drive. And I use this one, and here's a great way to do it. Some guy said, I took an old microwave oven and unplugged it and took the cord and grounded it. And I keep all my sensitive electronic devices in this old microwave so that they're safe from an EMP. And I'm like, really? So anyway, I tell everybody this because I've had too much coffee. But the real reason is it's stuff like that. I mean, the site is it's extraordinarily valuable from a community standpoint. It's not free. It's $15 US dollars a month. You can quit after a month, though, if you think it's not your, particular brand of whiskey. But most people that join stick around. So I encourage everybody to check us out. I think in a time like this, you need as many safe harbors as you can find.
Yeah, amen to that. Craig, it's a simple story, but I love it. I mean, it goes to show that people are still good. People are good.
Yeah, that's true. I see that too. I see the interaction of people, but excuse me, not to just tout it, but I do see those comments quite often about how, oh my God, this is so different from any other, other sites that I've been on because, it's such a community and people are helping each other. So it is pretty, as much as I like. Yeah, and I know that it is, generally people are nice still and try to help each other. We're not all at each, loggerheads, like the politicians want you to believe. But it's hard to find an outlet where, where that really is, that sense of community really does exist. That's for sure.
Yeah, I completely agree with that. Craig Hemke, I want to thank you for your support. And if I can have you back on again, well, the elections will be over by then. And I'm certain the U.S. and the world will be a very, very different place, but let's hope in a very positive way. So I want to thank you again, Craig.
Call anytime, my friend. It's always good to see you.
That was Craig Hemke sharing his views on the economy and precious metals. To see more of Craig's views and work, please do visit his website, tfmetalsreport.com. If you like this video, please do subscribe and give us a thumbs up. Both are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.